Hey everybody, how's it going? Welcome back to the channel. In this video, I want to do something just a little bit different. What I want to do is examine some market charts and see what they looked like during times at which the Fed was raising rates. The Federal Reserve has been dominating the financial news lately because everybody wants to see how many rate increases they have coming and exactly how fast they are going to raise interest rates. So that's why the market, in my opinion, is so choppy right now. They're kind of waiting for the Fed to kind of tip its hand and tell us what to expect. I think once the Fed gives the market a little bit more direction, I believe we're going to rally regardless of what they come out with. Now, if something comes out from left field and it is much worse than expected, I mean, I would expect the market to sell off on that. But I think if the Fed just gives us a little bit of idea of what they are thinking, I think the market is going to rally. But then again, that is just my opinion. But this chart that I have up is the federal funds effective rate going back approximately 30 years. What I want to do is look at market charts in these raising cycles, and the two in particular that I want to focus on is this tightening, or this period right here where rates went up right before the internet bubble, and this period right here when it went up right before the financial crisis. So right before these two major market tops are what I want to focus on. But we are going to take a look at the cycle that happened right before the COVID collapse, and also this one in 1994 to 1995. I know this was not a major market top, but just for laughs, just for informational purposes, we are going to take a look at that just to see how the market reacted. But let's actually get into the one that happened just before the internet bubble back in 1999. All right, so here's that time period from the late 90s that I want to talk about first. But before I get into when the Fed started increasing rates, there was this time period right here in late 98. In case you're not aware of it, there was the collapse of long-term capital management, which caused the Fed to cut rates because they thought it was going to have a massive impact on the financial system. So they cut rates from September of 98 till January of 99. So all the way till up here, they were actually cutting rates, and they actually started raising rates again in February of 99. So that's why you had this little dip in 1998, and then of course the run up into the news that they were going to be tightening rates, or raising rates again, I should say. And you got to also realize when they talk about raising rates or cutting rates, it's not like it happens in a day. It usually has been talked about for weeks or months, so the market has time to jockey for position. But right here was in February where they had that first rate increase, and the last one happened in June of 2000. So let's walk this thing forward. You can see it was a very choppy market during the time of the first rate cuts. So this is probably a time when the market was trying to see exactly what the Fed was thinking. And then once they did finally raise rates, it kind of gyrated around for a couple of weeks before it ended up making a new high. So let's walk it forward all the way till June of 2000. See if I can get the whole thing on this chart. Just about. Actually, this is April. Let me go one more time. But you can see right here was the first increase, and then the last one was in June of 2000. So you can see the S&P 500 continued to rise as they were raising rates. And actually, if we take a look at the NASDAQ, you can remember the NASDAQ is the one that had all those internet companies in it. So that is obviously the one that had the biggest gains. And you can see the NASDAQ just caught fire in the last quarter of 1999 all the way to the end of the first quarter of 2000. So this big run up right here was probably pretty close to the lion's share of all the gains in the NASDAQ in the 90s, just a huge percentage of the total gains. So if you actually sold out at that first sign that rates were going to be going up, you would have missed out on this huge run. So there can be a significant, lag between when the market actually tops out and that first rate increase. That's one of the main reasons I am not selling any stocks as of right now. I want to see how the market digests all this. I'm not saying that it's not going to be choppy, because I think it is. But you can definitely see, just because there are going to be some rate increases coming doesn't necessarily mean it's time to start selling out of stocks. But let's get into that period just before the financial crisis. All right, well, before I walk it forward to June of '04 when they increased rates back then for the first time, I just want to take a quick look at the market bottoming in late '02, early '03. Back then, rates were at historic lows, I believe right around 1% or so. And you can see as I walk this forward, it didn't take long for the market to rally before the Fed, decided to start raising rates. Only about a year or so from the actual bottom. Right about here till they raised rates for the first time. So you could tell back then the Fed was not comfortable with leaving rates so low, not nearly as comfortable as they are right now. But let's walk this thing forward. So the first raise was in June of '04, and they raised all the way until May of '06. So you can see from June of '04 right here, the market just continued to rally all the way into '06. So right here, it was when they stopped raising rates, and they actually caused the market to roll over for a little bit, made a nice little rounded bottom, and then turned around and started going back up. But they actually started cutting rates again in 2007, July of 2007, because the housing market was in a bubble. So here is July '07 when they first started cutting rates, and as you can see, the market started to roll over for the most part. It went back up a little bit, and then it started to roll over into 2008. So if you back this chart out a little bit, you can see right about here was when they made the first rate increase, and they raised it all the way into May of '06. So if you would have, taken the rate increases as a time to sell stocks, you would have missed out. And honestly, if you would have stayed in stocks all the way into that first cutting period, you would have made even more money. So just because the Fed is raising rates, it is no need to sell stocks just on that piece of information. But let's take a look at the other two real quick. All right, well, let's take a look at the rate increases from December 2015 that went all the way up into January of 2019. They raised them rather slowly, but they were rather consistent. But if you remember 2014 and 2015, there were some huge sell-offs, and 2015 was a strange year. Just kind of went sideways, and then we had a sell-off towards the end of the year that was pretty big. It wouldn't surprise me one bit if 2022 ends up being a lot like 2015, but just looking at 2015, let me walk this forward because that one happened in December. You can see we had this huge sell-off into August, and then as we got into December, it looked like it was starting to shore itself up, and the Fed decided to raise rates, and then we had another sell-off in it. But this, a year in the stock market anyway, seemed like a pretty strange year to be raising rates, even though we did have a rally going up all the way into 2015. But let me walk it forward a little bit. You can see we had the big sell-off after the first increase, and then it bottomed and found a floor in February of 2016, then started to push up. But let's just walk this thing all the way forward to 2019, and we can all remember that the market just had a pretty significant rally all the way up into 2019. Of course, 2018 was no picnic because we had that huge sell-off in the beginning part of the year. But, as the market does, we got that Fed put going on, and the sell-offs are usually short-lived, but then we got into that COVID collapse in 2020 after the huge sell-off into 2018. But walk it forward all the way to the COVID collapse, and the last one, of course, was in January of 2019. So this was the last time they tightened rates, was in 2019. They kind of let the market go a little bit, but then nobody really saw the virus coming, or at least I didn't. And then, of course, we had that big sell-off. So just because the Fed started raising rates in December of 2015, let me push this back a little bit here, even though it was choppy as all get out. If you had gotten out of the market or decided to lighten up in 2015, chances are you missed out on some massive gains in some of the stocks you decided to sell. But let's actually get into that period in the mid-90s. All right, so here's that last rate raising cycle that I wanted to talk about that happened in the mid-90s. The first one happened in January of 94, so right about here. And as you can see, if you would have gotten out of stocks right then, that's when you would have probably been feeling pretty good about yourself, because we had a major rollover not too long after that. And if you can see, all of 1994 was just basically chop city. And if you'd have stayed out of stocks, you probably would have been feeling pretty good about yourself that whole year, especially when you would have saw in the news that they were continuing to raise rates this whole time. Now let's fast forward to that last rate increase that happened in April of 1995 of that cycle, and that happened right about here. So if you would have stayed out of stocks, you would have missed that last breakout that it had in 1995. And actually, if you walk this thing forward, everybody knows what happened in the late 90s. The market just kept going and going and going like the Energizer Bunny, all the way up into the internet bubble and collapse into 2000. So just because the Fed starts raising rates doesn't necessarily mean it's time to get out of your stocks. Now, historically, that hasn't spelled, it hasn't been very good for high growth stocks that are losing money. But as long as you are diversified, I have some stocks that are high growth names, that they're losing money. I want to hold on to these for the long term, but I'm also well diversified as well. Let's actually go to the weekly chart so we can see all of it. But you can see the tightening cycle happened right about here, and the market went on a huge run. So who knows what is going to happen. It's my opinion, it's my theory that once the Fed gives us some direction, the market is going to rally. So I am not getting out of any stocks right now. I'm going to have to reevaluate how my stocks that are high growth and are not profitable yet react to this potential market rally that is going to come. If the growth stocks continue to get pummeled, then I'll have to reevaluate that strategy. But I am diversified enough into some other names that are still doing very well in this environment that I should be okay. I should be able to continue to accumulate some of those high growth names for the years to come. And eventually, once they do start making money, hopefully, those stocks start going up again. But those are my thoughts on this type of environment we're in right now. I know there's a lot of fear being spread that the Fed is going to absolutely collapse the market. But if you look at previous rate tightening cycles, it might not happen for quite a while after that first rate raise. So, there's no need to jump the gun as of yet. As of this video anyway, it doesn't look like the market has shown any real signs of collapse yet. But if that changes, I will let you guys know in the future. And that is the end of this one, guys. If you have any questions, make sure you leave it down there in the comment section, and I will get back to you as soon as I can.